Hello and welcome back to the Kepler Trust Intelligence podcast. This week we're speaking to Paul Major. Paul is the portfolio manager for BB Healthcare, a FTSE 250 investment trust that, as its name suggests, invests in healthcare companies from around the world. Before we begin, a quick reminder that past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decided to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Paul, thanks very much for joining me. Perhaps to start with, could you give some background on the trust, perhaps to people who are listening who aren't familiar with it? So, what sort of companies do you invest in? What sort of size? What sort of sectors? And if you can also maybe talk a bit about yourself and any other people managing the trust. So, how long have you been there? Any other important background information that you think is worth knowing about?
Sure. So first, let's talk about the product. So BB Healthcare is an unconstrained global healthcare investment trust, and what that means is we can invest into essentially anything that has healthcare as the primary driver of its of the investment thesis of the company. So we're not constrained to any specific group of companies from a particular index or region or country or anything like that. The fund is unusual. Um, and possibly I would say even unique versus its broader healthcare fund peer group for a couple of reasons. So firstly, it's very concentrated. We have a maximum of 35 holdings in the trust at any given time. We've averaged around 30 over the lifetime of the product, which is about 5.5 years, and we have 29 in the trust right now. So it's very, very concentrated. Because it's unconstrained and concentrated, it has a very high active share versus any of the comparator indexes, and a very differentiated kind of returns profile to those indices. The other thing is that it combines a bottom-up stock picking approach with a top-down thematic overlay. So in other words, everything we invest into has to fit a well-described theme, and that theme can be simply summarized as: we think the healthcare systems of the developed world are fundamentally broken. They're no longer fit for purpose to serve the needs of an aging population burdened with chronic medical conditions. So a chronic condition is something that can't be cured. It's something you have to live with and manage for the rest of your life. So, osteoporosis, type 2 diabetes, high blood pressure, cholesterol, dementia, all those sorts of things that unfortunately we all succumb to over time as our bodies age and wear out. And therefore we think that the healthcare delivery paradigm has to be completely reimagined and made fit for purpose in the 21st century to meet the needs of this population. And the challenges here are twofold. On the one hand, because the population of the world is growing, because the population of the world is aging, and because we continually unpick new ways of approaching the burden of human suffering through medical research, there is this relentless ongoing demand for products and services. But on the other hand, someone has to pay for all of this, and the burden of kind of um, the, the, the burden of care falls on the generally on the over 65s, who are the retired population. So they consume the bulk of the healthcare because their chronic diseases appear later in life and they have to be managed. Whereas it's actually the next generation that have to pay for all of this through healthcare insurance and tax revenues and so on. And we have a chronic shortage of skilled frontline medical personnel. That's not a new thing. It's been a growing trend for many decades now, but obviously getting significantly worse post-pandemic. And we feel that kind of Rubicon's been crossed. So we'll never get to the point where we'll be able to have enough staff to scale the healthcare system in a financially affordable manner. So we have identified various products, technologies, and services that effectively, if you think about healthcare as kind of an industrial process, we've identified where the bottlenecks are in the patient journey through the system. And we have looked for companies that provide products, technologies, and services that enable either physicians to make better decisions on the parts of patients, improve care outcomes, or lower cost, or in many cases do all of those things at the same time. And essentially we create a portfolio investments that are highly operationally geared into those particular pinch points, and help to solve those problems and improve the delivery of healthcare to the population as a whole. So in that sense, it's quite an unusual fund. We're not really interested in what's in any benchmark or popular in the sector or particular industry groups. We're investing in a diversified way into those thematic pinch points that we have identified as being the ones most likely to result in material improvements in the delivery of healthcare and the affordability of healthcare over time. The fund was launched 5.5 years ago, and I run it with my colleague Brett Dark. We have both got biomedical background, so I'm a biochemist by training. Brett studied medicine. We've both worked in corporate finance, and I've also been a sales analyst, and then Brett has worked for a long time on the investment management side, and we've got many decades of experience covering the healthcare sector, and that's what we bring to bear on the portfolio construction and investment decision making of the product. So that's a sort of summary of what we're trying to do, and how it's differentiated from the majority of the peer group, both in the closed end fund environment, but also in the open ended sector as well.
One thing that you touched on there was different pinch points that you think companies are active in, which would make attractive investments. So perhaps could you talk about, first of all, what those pinch points are, and then I'm sure there's lots of companies that will be active in a given sector that might be interesting. So are there particular traits or things that you look at to sort the good from the bad in those particular areas?
Yeah, sure. So talking about the areas, I mean, one way to think about all of this is to consider how one interacts with the healthcare system in the first instance. So probably reluctantly, but ultimately because of our age, inherited genetic characteristics, lifestyle factors. We all know that smoking, drinking, not exercising, and eating the wrong foods is all bad for us, but they're also all things that people enjoy doing. So inevitably, there's a tension there. So at a certain point of time, we all end up in that situation where we don't feel well, and we seek the help of the healthcare system. And if you think about your own interactions with the healthcare system, sitting here in the UK, your first challenge is you have to get an appointment with a GP. That's not easy. Since this is hypothetical, let's imagine you actually manage to get an appointment to see your GP. So you go. Indeed, you go in to see the GP, and of course, generally you don't have any medical qualifications, but you hope that the GP does. And so what they do is they sit you down and they ask you what you think is wrong with you, and then you go through this rather iterative process of trying to determine whether or not you have particular identifiable symptoms or characteristics that might help narrow down the problems that you have. They may then decide that you need some blood tests or some kind of a scan. So they then send you away, and you have to wait weeks for that, and then you have to then wait weeks for another GP appointment to come back for them to then tell you that the scans confirm what they thought was the problem in the first place. And then they will give you some kind of a treatment protocol to follow. And in the vast majority of cases, what they're basically doing is they're giving you something to alleviate your symptoms. So, you've got a rash. Okay, let's put some cream on it. You've got some kind of a swelling. Have some steroids. And so it goes on. Take pain relief for your joint pain that you have. So rarely are they actually addressing the underlying cause of the disease. And again, if we come back to this reality that around 75% of all the money spent in healthcare is addressing chronic diseases, they can't actually fix you anyway, because you're not fixable, at least not with current medical technology. So really, it's all about managing your symptoms to the point you go away and you stop bothering the doctor. But then there's a fundamental presumption in all of this, which is you are going to go where you're going to follow whatever medical advice you have. Why do you feel ill? Well, it's because your blood sugar is too high. Change your diet, do some exercise, whatever it might be. Or you've hurt yourself, so you need to do some physiotherapy. Or you need to take these pills for the rest of your life every day religiously, or you need to complete this course of antibiotics to alleviate this infection that you've got. And we know there is reams and reams of documented data out there that because we're all human beings and we're busy and forgetful, we're fallible, and most of these medicines do not make you feel instantly better when you take them. We don't comply with what the advice that the doctor gives us, and consequently we get a suboptimal outcome, and so the whole thing starts again. And if you start to think about healthcare as this sort of conundrum of how do you make that whole process work better, there's lots and lots of things you can do. So the first thing is, let's actually make medical appointments accessible by sifting out the ones that are unnecessary, and then there will be enough capacity in the system to serve everybody. So stat for you here, 1 in 4 GP appointments in the UK are deemed not medically necessary after they've taken place. You can see where the problem is with that conclusion. So we can firstly create additional capacity in the system. Telemedicine and virtual interactions are all part of that process, even if people are maybe not liking that's the new reality. It's definitely the way forward. Gate entry to the system, putting diagnostics at the point of care next to the patient. So those simple tests, 90% of the things that GPs see are the same things over and over again. It's very rare that you've got some complex or unusual disease that's going to require specialist medical knowledge. So why not put the diagnostic capabilities to definitively identify that in place at the GP? Then we can again alleviate that step where you go back and forward while we work out what's wrong with you. Putting in place simple interactive digital tools with the patient and the doctor to enable everybody to follow up with each other, making sure you take your medicine, making sure you're not having side effects, making sure that the medicine is achieving what it's supposed to be able to achieve, all these sorts of things. Again, if you start thinking about the elderly and vulnerable, making sure that someone who might be a little bit forgetful actually does take their blood pressure medicine every morning is kind of a critical thing, for example. So all of a sudden you can start to imagine a world where the whole process works very differently. But let's come back to the beginning as well. If you look at healthcare, Pareto's law applies as it does in everything else. So 80% of the costs and the resources are consumed by 20% of the people. Those people have either severe medical conditions, or they have inherited genetic characteristics, or they have serious socio-economic problems that prevent them from making those lifestyle adaptations that would improve their health. For those people that have got genetic problems, that they could be identified at birth if you did appropriate screening, and then we could start to think about diverting our healthcare resources to the people most likely to become part of those frequent flyers and stop them becoming so. And so again, over time, we can imagine ways to solve the conundrum of demand by focusing on the right people at the right point. So all of these things are actually, when you start to think about them in that sort of industrial process way, it's very, very easy to imagine that these things can be different and these things can be fixed. And that's what really informs our investment process. So the kind of companies we pick, how do we differentiate? Coming back to your original question, is we are generally picking companies where the product, service, or technology that they provide has been demonstrated to provide those benefits that we're talking about. So there is clinical evidence that it improves medical outcomes, or it improves care quality, or it lowers the cost of care. So if it's a drug, we're probably investing into a company before the drug's on the market, but in that later stage of clinical development where we can assign a reasonable probability to the drug actually reaching the market, and we can do that kind of pharmacoeconomic analysis on the cost benefits. If it's a medical device, it's probably been approved. And what tends to happen in medical devices is after they're approved, you then conduct real world studies showing you the benefits of using that device versus something else in the real world. And so we will be owning companies where the product is available, but that data probably hasn't come out yet. And so it's not in that phase of kind of mainstream adoption. So we tend to pick, certainly in healthcare terms, more small, mid-sized companies that are on that S-curve of adoption and uptake for the products that they provide.
Okay, and changing tack a little bit, if we look back over the past couple of years, I think it's been quite a surreal time for most people. But I would imagine that was particularly true for healthcare investors who might have had to deal with sort of more speculative behaviour on markets. So was that true for you guys? Was it true of the portfolio? And if so, did that present any challenges in terms of navigating volatility and so on?
Absolutely. I mean, volatility in healthcare has never been as high in history as it was in that early phase of the pandemic. And we certainly had to dance to the tune of the market in that regard. There were some, as you're sort of alluding to, some sectors that became really, really hot with retail investors and a little bit crazy, around some of the diagnostic companies, some of the COVID treatment or imagined COVID treatments, the vaccine companies clearly were a big bubble. And then once the vaccine clinical development program started in earnest, so it's worth remarking on the fact that this virus was described first in December of 2019 in kind of elite medical circles. The virus was sequenced, and that sequence was made publicly available in January, and in May we saw the first clinical data from clinical trials of a vaccine, which was the Moderna vaccine. That is a speed of development unprecedented in human history, and a real testament to the power of science and global collaboration. And I think that got a lot of people, retail investors particularly, excited about healthcare more broadly. But it also led to a rather surreal situation where lots of people imagined that the pandemic would be over by the end of 2020 to all intents and purposes. So healthcare, as you can imagine from a capacity point of view, suffered a triple whammy. So most of the patients are elderly and have these chronic medical conditions. So there's a degree to which they can be flexible about when they come in for operations. If you need a new hip or knee or cataract surgery, for example, it's life limiting, but it's not going to kill you, and therefore you can decide to delay it 3, 6, 9 months as you deem fit. So because these people were very vulnerable, a lot of operations were delayed. Capacity was set aside for COVID emergencies, in intensive care and other bits, and then the total capacity of the system was reduced through kind of spatial and temporal spacing, distancing, so that there was less likelihood of people infecting each other. We saw for the first time ever a significant reduction in capacity in the system. So that necessitated quite a lot of thinking and planning. I think we navigated that period pretty well. I would say if you look at our returns in relative and absolute versus healthcare in the wider sense. But then when we got to the end of 2020, it was very challenging because everybody started talking about the return to normal. And we felt that based on every pandemic that history had ever seen, there'd be multiple waves and it would take much longer than everybody imagined. So we were much more in the it'll all happen at the end of 2021, which ultimately proved to be true. So I think in some ways, 2021 was a harder year to navigate our way through. But then toward the end of 2021, really around October, we started to see something else which has been very challenging to understand and has impacted our investment returns quite significantly, which is if you take a step back and you think about healthcare more broadly, healthcare is healthcare, and it's driven by these demographic trends and innovation trends and what have you. It doesn't demonstrate any kind of cyclicality or economic sensitivity. At the same time, there's not really any difference between a very large medical devices company and a very small one. If you're serving a population well with a product that is widely regarded, then you're going to grow market share, you're going to grow in line with the market opportunity that's before you. So the only difference between a giant company like a Medtronic and a small one is that Medtronic has hundreds of products, whereas a small company might only have one or two or three or whatever, but they're all serving the same populations, the same marketplaces. So we started to see this really unusual trend where small companies started materially underperforming larger ones. And there was not really any rash. This is Q4 of 2021. Healthcare's at reopening. Operations are starting again. So we've got a tailwind. The broader economy is doing well. So I can understand why people maybe don't want to be invested in defensive sectors like healthcare. They want to be in pro-cyclical, reopening, consumer discretionary stuff. So I understood why healthcare maybe was struggling relative to the wider market, but I couldn't understand why all of a sudden investors didn't want to be in biotech or small mid-cap healthcare. And then as we rolled into the early part of 2022, of course, Russia invaded Ukraine, and the world has become subsequently a very, very strange place because of all of the supply chain and other challenges and inflation that we're facing. And that has exacerbated this divergence between the ratings, the valuation ratings of small and mid-cap healthcare and the valuations of large cap healthcare. Now, again, in any uncertain situation, people tend to crowd into very liquid stocks because they want to know that if they need to get out of the market completely, they can do so quite quickly. So what's happened there, I think, is that the defensive large cap, big pharma, big med tech sort of stocks have done extremely well because people know that they're not so sensitive to what's going on with Russia and Ukraine and interest rates and consumer discretionary income and all those sorts of things. But at the same time, nobody wants to buy, biotech or small med tech and things like that. So for our strategy, which is much more focused on those operationally geared smaller companies, it's gone from us being sort of market leading performance since inception up to the middle of 2021 to a much, much more challenging period of relative and absolute performance over the last 6 to 9 months. But within that, if you look at valuations for companies, they are at extremely attractive levels in the longer term. So we're sitting in this situation now where it's actually rather challenging because on the one hand, if you were a risk tolerant investor and a patient investor, and you could buy these companies at their current valuations, I think if you could then put them in a box and look at them 3 or 5 years from now, I personally think you'd have done incredibly well. But asking people to buy out of favour sector stocks within specific sectors at a time where they believe the world to be more uncertain than it has been in decades is obviously a very, very challenging thing to do. But our personal belief is that the weird world that you alluded to, certainly our corner of it looks like a very, very attractive longer term opportunity.
So building on that, I suppose there's a couple of questions. So one would be, would you say that price drops and so on that we've seen in the past 6 to 9 months have made you think twice about any of the companies you are invested in? And conversely, have price drops meant that you've been able to find opportunities that perhaps weren't there before?
So on the latter, yes, definitely. There are certainly opportunities out there. Now, there are clearly certain characteristics that are very challenging. So in this kind of environment, if you are a company that's going to require additional equity financing, so taking a step back, let's not forget that early stage development of drugs and medical devices is expensive and time consuming. So most of these companies in the early part of their life, they're not going to be cash flow positive, and they're probably over time going to return to the market periodically to seek more equity investment to continue the development of the aforementioned products. Now, if you're an investor in one of these companies and the share price is halved, let's say, which is a perfectly common thing to see in this current environment, and then that company needs to come to the market and raise, I don't know, $200 or $300 million, let's say, to get them to the next gating event in terms of clinical outcomes and regulatory outcomes in the journey to bringing a product to market. Then, if the market cap of the company was $2 billion and now it's $1 billion, you're going to get diluted twice as much when they do that necessary equity investment. And so it's completely understandable that people would want to shy away from companies that are likely to require meaningful additional financing in the short to medium term. Now, we generally, in our portfolio, for example, there are only 2 companies we believe will require additional equity financing in the next 2 years, and both of those have outcome events in terms of reporting clinical trials or regulatory outcomes or whatever between those things that hopefully should be broadly supportive of evaluation. But I can understand that some people might be kind of reluctant to buy companies like that. But as regards the rest, if you look across the industry, we've certainly had some challenges with regulatory uncertainty. The FDA, in particular, the US regulator for drugs and devices, they've seen huge amounts of staff turnover through the phenomenon known as the Great Resignation, and they've obviously taken on lots of new staff who tend to be younger and less experienced. So there have been lots of product delays on review cycles and things taking longer than expected, but one shouldn't conflate things taking longer with a probability that things are less likely to happen. Lots of people worry as well that M&A, which has long been a big driver for incentives to invest in small and mid cap healthcare companies, has gone away to some extent because of changes at the FTC under Biden, and also disparate valuations between small cap companies and large cap companies, which obviously have now reversed because those small cap companies have derated, whereas their large cap brethren have re-rated. But again, it's worth bearing in mind that M&A in this sector is inevitable for the simple reason that there's no empirical evidence R&D is a scalable business, and therefore the very large pharma and medtech companies, if you look at them, 20 to 30% of everything they launch as new products is either in-licensed or acquired by buying another company, and that trend is not going to change. And there was very little M&A during the pandemic period. So if you're a company and you're thinking about competitive challenges or patent expiries that can erode your earnings base, the urgency to do some kind of strategic deal in order to bridge that is more acute rather than less. So I wouldn't subscribe either to the view that is something that's become less likely than we would think a couple of years ago. So I would say yes. I think there are all sorts of interesting opportunities here, and for us, we're kind of GARPy investors. So we look at lots and lots of things, and we have a wish list of particular exposures or possibly companies we like in the portfolio, but only under the right circumstances of valuation and progress in their journey to realizing whatever it is that we expect them to do over time. And we've certainly had the opportunity to bring some things into the portfolio over the last couple of months during this period because they've been unfairly penalised in this kind of broader and disorderly market sell-off.
Okay, and have you used gearing at all to do that, or is that something you would consider doing, or are you nervous about doing so just given how volatile things are at the moment?
No, we absolutely have done. So our gearing has gone from being, at the end of sort of October, November, it was pretty low, a couple of percent, and now we're into the double digits. We're sort of around the 11-12% range. We can go to 20%. I think the reality is that we're not naive to the broader geopolitical environment, and we recognise that it's quite possible that the broader market may see further drops. So we want to keep our powder dry, obviously, to take advantage of that additional drop were it to happen. But also, one doesn't want to be close to 20 and then the market drops and then you're above the limit that you're allowed, and then of course you'd be a forced seller of assets at distressed prices. So we want to avoid that situation as well. So we're comfortable with a double-digit level of gearing. But as I say, the reason we're comfortable with that is if you look at the price of growth, for want of a better word, in healthcare, particularly small mid-cap healthcare, that you're seeing today versus what has been on offer over the last 5 or 6 years, it is materially lower, and that is I think a once in a generation opportunity, and therefore yes, absolutely, we've taken advantage of the flexibility that the investment trust structure has to put some gearing in there and increase our overall exposure. Now, from a market timing point of view, we've been buying all the way down, so one could argue we've been wrong to be doing so. But on the other hand, I think picking the bottom is very challenging, and events can move quite fast, and we're really looking at this on a multi-year period in terms of realising our returns from doing it. So again, I think it may look like not the appropriate thing to be doing in the shorter term, but in the longer term, we feel it very much is the right thing to be doing.
Great. And perhaps a couple of questions to finish off. So one is, are there any sectors that you are particularly excited about? And conversely, are there any areas that perhaps you think are worth avoiding, particularly if they're more counterintuitive? So, as in, if there's a particular area that seems to get a lot of hype, or lots of people would assume would be good to invest in, but you perhaps see things otherwise?
Well, I think that there are a couple of things to say there. So in in terms of where we see really significant opportunities, I think one of the big thematics that's become prevalent in our portfolio post COVID is really the management of people at home. So medical management. I'm not talking about sort of Meals on Wheels for the elderly, but the idea that if you have an inconvenient chronic condition, so let's imagine you have rheumatoid arthritis or cancer, for example, and you need to have infused drug therapy. Why do you go to the hospital to have that therapy when you could have it administered in the comfort of your own home, and in so doing not expose yourself to the risk of all sorts of communicable diseases, which is particularly problematic if you are having chemotherapy because it hurts your immune system? Why do you want to go to a clinic 3 times a week for 7 hours to have dialysis when you could have it at home? If you're having physiotherapy, why do you go to a clinic for that? Why can't a physiotherapist come to you? And so on and so forth. And technology is enabling those things to be done very effectively, and for the appropriate data and supervision from a physician perspective to be scraped via all sorts of connected tools. You can imagine with phones and iPads having cameras and internet connectivity, you can have people at home and you can monitor all sorts of parameters about them and how they're doing and what they're doing in ways that weren't really imaginable 10 years ago, for example. So the transition in the care setting is something that we're really excited about. We've been interested in this for a long time, but it always felt like it wasn't quite ready for the prime time. But because of COVID, people have recognised that hospitals are nasty places full of sick people, and they'd probably rather not be there. But the other point of this is that they're incredibly expensive, and people do much better when they're not in them, because they're depressing places to be, and so you actually get this virtuous trifecta of all the things I've talked about before. So you get better clinical outcomes, you get happier patients, and you save money through this transition into the home care setting. So we've got quite a lot of skin in that game, and that's something that we're really excited about. In terms of things maybe to be a little bit careful about, I think lots and lots of people are crowding into large cap pharmaceutical companies because they're very big and liquid, and their portfolios are very diverse, and they're unlikely to be impacted by the pandemic, but by recurrence of the pandemic, or by the geopolitical inflationary issues that we've talked about, because they've got high gross margins, all those sorts of things. Let us not forget that the reason that large cap pharmaceuticals hasn't been a very good place to be invested for the last 5 or 10 years is because of the point I alluded to earlier about the lack of scalability of R&D and the dependency of these companies on externalization in order to keep growing. That hasn't changed. So while I understand that people are hiding in these things because they are the logical place to hide, I think if you're a more retail focused or private investor, it's worth considering that when the opportunity re-emerges to feel safe investing in pretty much anything else, people are going to drop these things because fundamentally they're not good companies, and they haven't improved their long-term competitive position. So that's something that I think people just need to be wary of. So in many times when markets are going through periods of significant uncertainty, certain things work very well until all of a sudden they don't. And I think large cap pharma runs a very high risk of falling into that category. So carry out emptor on that.
Well, Paul, that's that's all we've got time for. So thanks very much for joining me, and hopefully we can catch up again at some point in the future.
Thank you very much.